Okay, so we are Tuesday, the 3rd of January 2023, and we're going to have a quick summary of what is on the general market radar at the moment and what we should pay attention to moving forward through this year. Okay, so I'm not here to put out predictions. I'm just really here to, summarize and put into context, what lies out there on the mind of the market at any given time, and then key levels maybe, or sentiment and whatnot, right? So generally I think for 2023, things we need to be aware of, the context of coming forward here is obviously rising rates. And within that, you have, a lot more, much more expensive credit, right? And within that, you have corporate credit. Corporate, personal loans. You've got, within that, you've got auto. You've got home. Oh, whoa. That functionality on my pen. Hold on a sec here. Yeah, you've got auto. You've got home. Corporate and personal. And then, so that's it really. We don't really have a third one there within the credit that we're going to be talking about. But then we also have, the jobs market. Then we also have, energy. And these are the real core ones that will move these markets. But one of the largest now is earnings. Earnings and corporate performance. Right. So I think to talk about rising rates, and I think this is going to be the biggest, more pervasive driving element on how we will finish up 2023 and how these markets will make their biggest moves. Well, I think we need to really, have a look at credit and the rising rates. Now, the terminal rate, as in where the Fed see them wanting to get rates to, is sitting around 5.16%, right? And they're looking for that for March. Now, if you're in the Stanley, why is that important to know? Well, it's important to know because if the Fed are kind of telegraphing where they want to stop, at 5.1, yet if we have a double push on inflation, like on a double head on inflation coming in, if we see inflation start to rise back through, say, Q1 here, the Fed are going to just rise that terminal rate up to to 6-7%. All right, 7%. 7% rate from the Fed is not good for any of this picture here. None of this picture. Okay, it's going to absolutely destroy this. Absolutely destroy. So what are we looking at? We're looking at 5.16% for March. It could go to 7% by, say, Q2, right? Now, if you're of the Druckenmiller school, he said that inflation has never come down unless the Fed's rate rises above CPIs. And then you're looking at, what are we looking at? Like 10%, let's call it, like 9-10% there. Okay. Now, it's unclear, and I maybe need to do some investigation on whether it's the Fed has to go above the peak of the CPI or it has to go above current CPI. But either which way, we're looking at somewhere between 7 and probably 9% there, right? So what's the knock-on effect of that going to be? Well, it means that this corporate credit space is going to dry up. All right. This means that essentially people are not going to be borrowing at 7% when they're only really looking to do 3 to 6% per year with that money and with that credit. All right. Just doesn't work. They're running a loss of, say, 1 to 2%. Okay. Now, unless the projects that are going online on on corporate credit are looking at 12% yield or 9% yield, for example, well, fine, but you're kind of going to lose like 0.5% to a 1% in the mix. So really, corporate credit space is going to dry up. All right, personal credit. Where do we think that's going? Forget about it. Yeah, we can't fully forget about that. And you know why? It's because people on the street don't understand these interest rates and they just want the money. They just want the project done. They don't give a shit. All right. They just don't give a shit. And they just don't understand whether it's 2%, um, 2%, or whether it's 2% interest rate or 15%, they don't give a shit. They just want their project done. They just want the credit. They just want the car. They just want the handbag. They just want whatever. So actually, the bulk of personal credit will dry up, but there's always going to be people there who just want the cash, right? What we're already seeing happening, the canaries in the coal mine here is home is getting destroyed. We already have down prints in home loans and new builds, all that sort of stuff. And auto is also falling off a cliff as well, right? So we've got that coming through. You've seen the posts I've put in about jobs as well. I think the Bureau of Labor Statistics is really making these numbers sound a bit better than they are. And, they're essentially combining part-time work with full-time work to make the overall people at work figures look better. That's a very, very, very simplex summation of how they're doing it. Okay, so the jobs are lesser quality jobs. They're lesser earning jobs, and it's more part-time stuff, and it's less high quality jobs coming through. Basically on the NFPs, right? Now, because and the reason why I want to talk about this is because I think NFP, we're going to have to be a bit smarter about how we read and interpret NFP. And actually, that's why I think you're going to see some NFPs come out with beats, but the market will move down against them. I think you'll see an initial bid against an NFP beat and then a total unwind and putting in new lows from the point that the data came out, or new lows on the day or the week. But what we're going to do is we're going to wait. We're going to watch how the first NFP trades. I think we're due this Friday, are we? Let me just check the schedule to see if it's on, notwithstanding the holiday. For Thursday, Friday. Looks like it is. Yeah, we are. We're on for non-farm this Friday, right? And non-farm 200,000 is what the street's looking for on that. Okay, so NFP, I think we're going to have to be a bit smarter here, and we're going to have to really not trade this on the data. We have to be smarter, right? And I think we actually have to look past this NFP number a little bit here. and actually, probably wait until the market opens and then see how the market wants to trade against the activity that's happened on the data, because retail traders are not really going to give a shit. They're just like, beat on the number, I'm buying, miss on the number, I'm selling. And it's that simple sometimes. But we're going to stand back and we're not going to be hitting these numbers, and I'm not going to have any fast, concepts against NFP when we're trading into them. Okay, so I think jobs, we're looking at a bit of phony data coming through here potentially. Well, not phony data, but just confusing data, I should say, right? But we're gonna leave it at phony data. Okay, energy. All right, energy. I mean, shit. Okay, energy. We're gonna look at energy here. I think now that we have finally we have diminishing Russian production. Okay, there's a lot of factors here. Okay, Russian production number one. Two, China reopen. Um, I and then the reinvestment picture. Okay, I think we're actually in a perfect storm now when it comes to energy. Okay, so we have essentially a trifactor here for the bullish scenario. We have diminishing Russian production. Okay, we have China reopening. Now, what we haven't seen is the market pricing in a huge amount of demand coming back from China. Why? Because China specifically built quite a lot of storage facilities when oil went sub-zero. They couldn't build them fast enough, and they were soaking up as much global production at that time as they could. And there was a lot of tankers sitting off the coast of China, essentially waiting to then dump into these facilities once they were built. Okay, so China is working down, some of that built up storage that it's had, essentially its version of the SPR. Okay, and that's why we're not seeing a hugely aggressive bid coming into oil on the back of reopening story in China. Okay, but we will start to see that. And one of the canaries in the gold mine there is going to be the Shanghai refiners. So we're going to try and investigate that in here and have a look at Shanghai refinery rates. Okay, I think that's going to be very important for us to then try and look at where is demand pickup happening, or when, I should say, is demand pickup actually happening in China. Okay, now I think it's going to be actually quite obvious on the tape, on the price action. Once it does start to happen, and once we do get that kind of rise in Shanghai producer or refinery utilization, for example, I think you're going to see some serious popping on the tape on oil, on Brent, on WTI, and all the grades really. So we need to see refiners back. Refiners back. Up. Refiners. Increased rates. Okay, and that would be probably week on week. And then the reinvestment picture. Now, this is interesting, and this is actually quite bearish, right? Well, sorry, actually, no, sorry. So this is quite bullish as well. Bullish. Okay, so if you're an oil company and you want to leverage money or leverage assets to reinvest, you've waited out, you've waited for the dust to settle from COVID. You said, like many companies, you said, I'm not going to reinvest in E&P exploration and production or development of wells until 2022. And then it got into 2022, and you go, Russian invasion, SPR release, maybe I'll just wait out a little bit more. And you go to 2023, and you knew it was coming, but the rising rates have now happened. And so now you're going to have to go to market you're going to market at rates of, north of, currently north of 4.75. Now, you could probably, as an exploration and production company, you could probably lock in a lower rate of maybe like 3, but that bank is going to be coming back to you like in the next quarter saying, well, I don't think you're going to get fixed rate at 3%, right? You're not going to get fixed rate at 3% when potentially the Fed may have to move up to 7%. And then, you could just get 7% by as a bank, essentially by doing nothing. So why would you have to forego earning 7% when you can, why would you lock someone in on 3% when the risk is only to the upside on the rates, right? As a bank. So as an oil company, you're going to be going, shit, I need to get this in here. I need to get my loans done now. Now we're just getting some of that UK data coming out there. PMI final actual 46.3, 45.3 over 44.7. I think Euro may start to lift off this MP val here. Anyway, so essentially it's quite bullish because you're going to have to reinvest your own cash. You're not really going to want to loan the money because it's going to be quite expensive. You probably, if you really believe in the project, you're going to use your own cash. But either which way, I think the credit for oil companies and energy companies is credit is tight. So probability of reinvestment right now is low. Reinvestment probability is low. And that is going to mean an even overall a tighter supply and demand market. Okay. And on the supply side, are we going to see demand destruction? Well, you know what? I don't know what percentage of the public need to hear this, but not everyone wants a Tesla. Not everyone wants an electronic vehicle. Not everyone wants a car that can't start in sub 30 degrees Fahrenheit temperatures. Okay, people like their carbon cars. Okay, it's the transition is going to, what are we, 23? The transition isn't going to really fully kick in until 2040. Okay, and that's the best minds in the world have touted 2040, 2035, 2040 as being that nexus point where things can start to really shift over to being, maybe 50% of cars sold are electronic vehicles. All right. I don't care how many recycling bins you have outside your house. I don't care how many avocados and, vegan lattes and all you drink. The world is not yours yet. Okay. The world is not there yet. Okay. So demand drop off. Give me a break. All right. Give me a break. All right. I've been talking about demand getting crushed for the past 40 years. Right. Whatever. Okay. So that's where I am on energy. And I would say that I am talking my own book. I am 100%, 95% on invested in carbon at the moment. Okay. earnings and performance, and this is really going to be where we're looking to capitalize on these indices, on these equity indices. Okay, so I think we really need to be paying attention to these earnings performance reports as they come out for Q1 and Q4 is, the recession coming. Well, I think this is a Fed-led recession via credit, tightening the credit. Therefore, they can tighten up the whole economy. All right, but that's one thing. But if the earnings reports come in steady and in line, the market's going to go up. The market's going to keep going up. And I think what we need to look at here is number one is lag, i.e. the Fed policy lag effect. All right. When are these higher rates really going to kick in to these markets? All right. When is it really going to take hold? Okay. And I think it's going to be Q2, end of Q2 onwards. Okay. I think we're going to start to see the earnings stutter a little bit at that point, and then the market will say, yeah, you know what? I don't like the look of this. This looks like the end of the lag period. And I think we're out. And that's when I think things may, I agree with Jason in that we can, run up run up high on equities prices through Q1, through I think okay to decent earnings performance in Q1, and then I think the marketplace is going to find it a bit harder to tack on ever increasing earnings and positivity thereafter. So I think for Q1, I think we can look for the longs on equities. I think we can look to buy pullbacks, buy really deep pullbacks. But we'll see. We're going to see. We're going to trade day to day here. The second thing I think to look out for on equities is the wheat versus the chaff, right? Now, what do I mean by this? I mean basically leveraged growth versus sort of bootstrap growth. Now, bootstrapping basically means is I make $1, I reinvest 50 cents, and I pay my costs with the other 50 cents. Not bootstrapping is I make $1, I spend $1. Okay. I spend $1 on growth and paying myself. Right. That there's no reinvestment there to grow and grow and grow. So what's a leverage company versus a bootstrap company? All right. What company, and this kind of feeds into the Bill Ackman, one of his 8 investment criteria is essentially a company that generates its own cash flow and doesn't really need to go to the markets for financing. Okay, so guys in the room, does anyone have a company that's highly leveraged that needs to keep going to the markets for money? Don't all shout at once. Let's look at, say, God, I'm trying to think of one now. Tesla, maybe. Yeah, let's put it out there. Tesla. Let's put it out there. I don't actually know how much they need to go to the market for, but selling bonds, but I'm pretty sure they do. They would need to, given what we've seen of Elon's finances over the Twitter acquisition. I think he's not as liquid as he was, but asset rich, cash poor, as they say. And so yeah, say Tesla, crypto space. Crypto is just leverage upon leverage upon leverage. Absolutely. Yeah. Crypto space. Crypto space. It's not really I'm looking for a company though. Um, Company here would be, let's say, uh, a company with high capex. Let's say Facebook or Meta, or if you used to call it Meta, Facebook. Let's say Meta. Okay. Now, bootstrap company, guys. What do you got? Company that churns cash. Well, you know it. I'm a little bit hesitant to put Netflix in here because it does need to sell bonds to fund production on its slate. But hey, it gets a return on the slate, right? So they've got some good. I think they have good earnings, and they're producing their own cash. I think they could fund a certain amount of production out of their own cash. They're getting to that spot now. Apple, Netflix, look, Microsoft, yeah, uh, you know, all the big boys. Like, actually, I'm not going to put IBM in there because I think they're in a bit of trouble, really. Um, where's my list of the big boys? I mean, I think that's enough to go on with. But I mean, look, no one's going to give you a gold medal for saying, well, you should invest in Apple over Tesla, right? Well, thanks very much for that consultation, Tim. You're a hero. No one's going to pay you for that advice. Meta over Netflix. Yeah, that's a bit more nuanced, but Netflix are, I would say, more secure than Meta. I've seen the demise, by the way, of Bebo and MySpace and countless other, uh, you know, social media platforms that were like 85, 90% revenue was advertising. Okay, I mean, shit, what was it like? I can't remember what year it was. Maybe 2009 or 10. I was working with an ad agency. I was a subcontractor. My company was subcontracted for an ad agency. I remember I went in one day and there was like shock, and because we had an office that we shared with BBDO in Dublin, and there was shock across like the account management floor, and they were just like, they're like, Toyota just pulled all of its advertising worldwide for the first quarter. I was like, what do you mean? And Toyota was one of their clients, and they're like, well, they have zero advertising spend, no spend. They've cut all the spend, and I was like, wow. And that led to the demise of a lot of advertising led businesses, huge amount. And it really led to a nice little shake up in the traditional advertising space, killed off a lot of zombies. But basically, what I'm getting to here is the wheat versus the chaff. Well, the wheat is here. This is the wheat. And this here is the chaff, right? Leverage growth. Okay. So I think in the higher credit market, I think the metaverse, unfortunately, might be put on hold in Q3, or development on the metaverse. Yeah. So, you know, basically what I'm getting to here is, I think, the surprise beats on earnings will come through Tesla and Meta. I think the market will have a nice couple of jolly days to the upside, but really for continued strength, you want to see that these markets are holding their technical fundamental pictures to the upside in order for these equities markets indices to also hold to the upside and for pullbacks to be bought. So that's kind of really the context of where I see we're going. Oh, where I see, or the context for the year, um, that we need to be aware of. So rising rates, I think we're going to have really shitty data coming across on the squawk. Data that we trade all week, every week. And I think we need to really monitor how that data, especially through January, how that data impacts these markets. We've seen really bad data come out of the jobs market in Germany this morning. What do we get? What do we get? What do we get? We got negative 13,000 on the unemployment change. Actually, sorry, negative 13,000 on the unemployment change is actually really good. Sorry, that's really good data. Yeah, Monday back, first day back, not with it here, but the unemployment change is really good, but euro is only really taking a bit of a positivity with now. So we need to monitor how the market reacts against how this data breaks. I think NFP is going to be the big bullshit piece of data, and I think it's going to become less and less important as we go through this year. Although there will be still huge volatility over that data. I think energy, we need to really be aware that the big bid from China reopening is really going to only come through from refinery rates in Beijing and Shanghai. All around the Chinese mainland area is starting to rise. The reason why we're not back up there now is because they still have huge storage and they're working through that storage. And the reinvestment picture, I think that's blown out to shit. So I think they're going to have less supply to go around through 2023. Fed policy then being the main driver for equity growth this year. I think once we start to see the lag effect is gone, that's when we're probably going to then the markets are really going to then start to come off, because it would make sense that once the Fed is getting its way, then the markets will really stand back and kind of let the markets drop, or the participants. And then for investment going forward, you don't want to be on leverage growth companies. All right, so I've talked enough there, really, on this. So hopefully that's useful to you guys. All right, any questions? Just pop them at me right now, or I can answer them as we go forward through the rest of the week. All right, cheers.